Hi, I'm Rick Lear, founder and chief investment officer of Lear Investment Management. Today, we're bringing you our 5-minute market update from our offices here in Dallas, Texas. In the update, we're going to talk about 3 things. 1, the current risk that exists in the market and our assessment of each of those risks. 2, the case of stocks versus bonds. 3, we're going to look at the themes in which we are invested in. We'll start with the Director of Research, Jim Warner, who will discuss the first 2 points.
Thank you, Rick. We believe that there are 4 key risks to the market going forward that we are monitoring very closely. First, new cases of the coronavirus could accelerate. As our economy reopens and our freedom of movement is increased, all eyes will be on changes in new cases. We believe that there could be some new clusters of cases, but that a dramatic surge is unlikely because, number 1, the reopenings are going very slowly around the country, and number 2, considerable time is being taken by businesses to implement social distancing strategies and techniques. And 3, people are very aware of what risky behaviors to avoid. But what if new cases do surge, and even worse, lockdowns are put back in place and the economy worsens? Well, we believe that there is bipartisan consensus in Washington to throw as much money and stimulus at this problem as is needed, no matter what happens from here. But what if this bipartisan consensus fails? We believe it cannot. Given the upcoming elections and the fact that it was the government itself that put the economy on pause, that both parties find themselves in a prisoner's dilemma. Neither can say no to more money. The 4th risk is, are equity valuations too high? We believe that with nearly $6 trillion of fiscal and monetary stimulus in the economy today, and with more on the way likely, the valuations could actually go significantly higher. In fact, we went back and looked at a modified Fed model in which we compared the yield on the 10-year Treasury, the blue line, to the dividend yield of the S&P 500, the orange line. We found that since 2006, every time the 10-year yield was lower than the S&P 500's dividend yield, the market rose. Today is one of those moments. Stocks are significantly undervalued relative to the 10-year Treasury and are begging to be bought. Now let me turn it back to Rick.
Our purpose is to help investors grow their wealth over a long period of time. To do so, it's pretty simple. We try to identify securities that will trade at a higher value in the future. So an integral part of this process is identifying key themes with strong secular tailwinds that will drive revenues of stocks into the future. In this demonstration, in this chart below, we have identified 3 main themes to guide our stock selection. The first theme we call the new normal. These are mainly technology companies. Many of these companies are in areas we've invested in for years, but because of the crisis, the theme has accelerated. Think about with businesses closed, with malls closed, with restaurants closed, and with retailers closed, the amount of information that is being forced to move into the cloud. Also, with people at home, they're communicating, they're shopping, they're playing video games in a very different manner, and most of that is online. Another key theme in this area is biotechnology. The race of the scientific community to find a vaccine or treatment to the virus has only accented and further put a spotlight on the importance of the scientific community and those companies. The second pool of assets to complement the new normal stocks are what we call distressed equities. These are stocks that have sold off as a result of the virus. Many stocks in areas such as home builders, energy, financials have been brought down to levels where it looks as if they're forecasting a depression. We do not think the outcome will be that bad, and we're finding some very attractive areas to invest in. For example, home builders. We believe not only will home builders thrive, but they may see a new wave of resurgence as people try to move out of the urban areas. The third bucket we call yield. In this very low interest rate environment, where a 10-year government bond yields less than 0.6%, it is important to drive some yield into the portfolio. We look to a few interesting areas for yield. 1, renewable energy. This is a theme that is not going away and is going to be a very important part of this next decade. To lower risk in the portfolio, we also look for some other fixed income instruments, such as mortgage REITs and some short duration corporate bonds. Both of these areas of fixed income have the Federal Reserve as a backstop, so we feel comfortable holding this debt. Now, it's important to note there is not an all clear in the economy. There will always be uncertainties. Thus, we keep what we call hedges, which underline the portfolio. This includes gold, gold miner stocks, and to some extent, cash. In summary, it's important to understand the risks that exist in the world. It is an uncertain world, and it'll always be an uncertain world. There are always uncertainties out there. It's our job to understand the risk, to understand the trade-offs of investing in stocks versus bonds, and then to identify the securities that we believe will prevail and help our clients grow their irreplaceable wealth into the future. This uncertain world has created many opportunities in the investing world. We continue to work tirelessly to identify those and help protect and grow your irreplaceable wealth.